You know, there's a piece of financial advice out there that you've probably heard a million times. It sounds so responsible, right? So wise. But what if I told you it actually sets you up for failure? Today, we're going to take that piece of advice, put it under the microscope, and tear it apart.
Yep, that's the one. Invest only what you're willing to lose. You hear it everywhere, don't you? Especially when people are talking about something new and exciting, like a hot stock or crypto. And, on the surface, it sounds like good, cautious advice, like it's trying to protect you.
But let's just stop and actually think about that for a second. Is walking into a situation already accepting a 100% loss the right way to start building your wealth? The answer is a huge, emphatic no. This little phrase isn't just bad advice, it's a trap, both psychologically and technically. Honestly, from now on, whenever you hear someone say invest only what you're willing to lose, that phrase itself should be a massive red flag. It's a signal that the entire approach you're about to hear is probably flawed from the get-go.
So, who's actually saying this stuff? Well, it usually comes from one of two people. First, you've got the well-meaning folks who are just repeating what they've always heard without really digging into it. But the second source is way more dangerous. It's someone trying to sell you something incredibly risky. They use that phrase to make losing all your money sound normal, acceptable even.
And this really gets to the core of the issue. It highlights the massive gap between what I call the casino mentality and how a real professional actually approaches money and risk. They are two totally different worlds. Just look at the difference here. It's night and day. The amateur with the casino mindset walks in and says, I'm willing to lose it all. It's a bet. The professional, on the other hand, asks a completely different question. What is the maximum acceptable loss this portfolio can handle before my strategy needs to adjust? See? They don't plan for total loss. They plan to manage ups and downs. And pros don't just guess. They use actual tools to replace that guesswork with cold, hard data. One of the basics is called maximum drawdown. All this does is show you the absolute biggest drop an investment has ever had in its history. So instead of vaguely being willing to lose, you can look at the data and say, okay, this thing has dropped 30% before. I need to be prepared for that possibility. It's about planning for volatility, not surrendering to failure.
And if you want to get really serious, the big financial institutions use models like value at risk or VaR. Now think about this. It completely flips the amateur mindset on its head. Instead of saying, I'm willing to lose everything, VaR says, with 95% confidence, the most we expect to lose over the next month is this specific amount. It's the polar opposite of gambling. It's about defining and controlling risk.
So the main takeaway here is pretty simple. The entire world of professional finance is built on a foundation of managing risk, not just accepting it. It's all about having a plan for the market's natural ups and downs, which we call volatility. It has absolutely zero to do with being willing to watch your money vanish.
But here's the thing. This isn't just about having a pro mindset. There is a fundamental, technical reason why the idea of losing everything is just plain wrong when it comes to proper investing. It's not just unlikely. For a diversified portfolio, it's practically impossible.
Let's just game this out for a second. For a simple, diversified global stock fund to actually hit a value of 0, what would have to happen? Well, first, every single company in that fund, we're talking hundreds, maybe thousands of them all over the world, would have to go bankrupt. Second, they'd all have to fail at the exact same time. And for that to happen, the entire global economy would have to just cease to exist.
And look, if we're living in a world where every major company on Earth has simultaneously collapsed, trust me, the value of your stock portfolio is the absolute last thing you're going to be worried about. At that point, we're talking about a zombie apocalypse, and we'll be more concerned with finding canned goods than checking our brokerage accounts.
Now, this whole willing to lose idea often bleeds into another concept, the idea of fun money. That small pile of cash you set aside for your riskiest bets. But this, too, is really just a symptom of that same flawed thinking.
Just listen to the language we use, playing the market. That says it all. Investing isn't a game you play. The second you start thinking about it in terms of a game you might win or lose, you've already adopted the casino mindset. That's not a strategy.
Because what is investing, really? It's the serious act of putting your savings to work in the real economy. You're buying a small piece of a real company that makes things and employs people. It's your participation in economic growth. That's your financial future. It deserves a serious, disciplined approach, not to be treated like a weekend trip to Vegas.
Okay, so if willing to lose is the wrong framework, what's the right one? Well, it's all about shifting your entire mindset from one of accepting failure to one of preparing for risk. And you do that by asking much, much better questions.
I mean, just think how absurd this logic sounds in any other important area of life. Would a surgeon ever say to you, hey, only agree to this operation if you're willing to not wake up? Of course not. Would a pilot say, only get on this plane if you're willing to crash? No way. They manage risk with checklists and training and systems. They don't just throw their hands up and accept the worst. Why would you do that with your money?
And that right there is the fundamental shift. Your goal as an investor is not to be passively willing to lose. It's to be an active participant who understands the potential risks, prepares for them, and has a plan to navigate them. It's all about preparation, not surrender.
And that new mindset immediately leads you to ask smarter questions. Instead of, can I afford for this to go to zero, you start asking things like, how long do I plan to hold this? Or am I actually ready to see this drop 20% and not freak out and sell at the bottom? And most importantly, how does this one thing fit into my big picture financial plan? These questions, they lead to a real strategy, not just a blind gamble.
So the next time you hear that old saying, you'll know exactly what it is. A sign of a gambling mindset, not an investing one. Because real, long-term investing isn't about being willing to lose. It's about having a plan to manage the ride. Which leaves me with one last thought for you. What other pieces of common financial wisdom do we all just accept that it might be time to throw out?